of the buyer. So one is to increase amortization, the other one is to take it out. One is an FVA, and the other one is a unmaterialized gain. They're two different things. They're two different concepts. The FVA, as a parent, you paid for that. The $750 is actually a gain that you don't deserve. And then the other one is simply mine plus yours. Why are the transaction on the plant and equipment and land and whatever not in there? Because they happened in 2009 or 10 or 11, but not 2013. That's why you have to read the dates very carefully. A net income is for a year. Retained earnings will pick up all the previous years. So that's your profit before taxes. Now your taxes. For your taxes, you go back to your schedule if you've done them, or you go and pick up every adjustment that you've made. 900 here, 500 and 750. These are the gross amounts. The 30% of it will play into the income tax expense. So the 900, the 500 and the 750. So 150, that's related to the 500. 500, 150. Why minus? If you increase an expense, you decrease net income, or income before taxes, you will decrease taxes. The other way, minus 750 at 30%, plus 225. You take away an expense, you bring up income, pay more taxes. And the 270, an increased expense, decreases income, decreases taxes. It's your only way to see if you're right or wrong. I could, definitely, because you have to be able to conceptualize what is a consolidated net income without sitting down and doing the full income statement. What is a consolidated net income? Those formula are more than just proofs. They actually prove me that you understand what is consolidation. That's what they prove. Not that you can just add columns, but you can conceptually understand what is a consolidated net income. It's your income plus mine, minus dividends in between, plus and minus MFVAs, plus and minus ITs. So you can calculate consolidated net income in 5 minutes, while it can take you 45 minutes to do the income statement. Which one would you prefer? The 5 minutes, huh? And it's also especially in exams, when you don't balance and you don't know where your mistake is, then you have to start verifying, okay, where can have I gone wrong? And also in real life, often we don't balance and we wonder, what have I done? As I told you, sometimes it takes me 5 minutes to do a consolidation, sometimes it takes me 3 hours too, because I've done a silly mistake somewhere. But I will find it, that's for sure. So do you approve? No, the time. I've helped you out a little bit. At the beginning, you see the net income of Lara, which you could find out by taking your calculator and taking the trial balance, sales, all the revenue accounts, the credits minus the debits. You would find it is 30,000 for the trial balance, and it is 25 for the sub per the trial balance. So 30 and 25. So does it work? $30 plus 25, minus dividends, minus MFVAs, minus plus and minus ITs. So 350. In the formula, can you work at gross or net? What's best? Net. Carry as less numbers as you can. It has to be quick. A formula takes 3 seconds. Doing the income statement takes 40 minutes. The MFVAs per your schedule is the 350, which is the 500 minus the 150. The 630 is the 900 with its 270. 630, and the 525 is the 750 and it's 225. So are we sure of our 36, 545? We're sure that way and we're sure that way. Vertical for the income statement, horizontal for the formula. retained earnings statements? How can you find retained earnings opening? If it's not provided, you don't have a choice this time. You have to use the formula. So can I ask in the exam? Of course. To find out retained earnings opening, unless we give it to you from the previous financial statements consolidated, you don't have a choice. You have to calculate them. Or work backwards. Calculate the end, knowing the net income, then you find the retained earnings opening by deduction. That's also a way. But finding retained earnings by deduction is always a scary thing. Do you have a number? No number? 167,512? No. Too big. 129, 152. Which you could find actually with the numbers I've provided you. You can just work your way back up. But with the formula, 90,000. What's 90,000? My retained earnings. Make sure you have the proper dates. It's all about dates. 90,000 is the retained earnings of the parent at the date we are, 19. provided by your trial balance. 86, retained earnings of the sub right now, January 1st. 45, acquisition, pre-acquisition adjustment. CMFVA of 1,050 per our schedule. And IT of 3,938 and 3,005. 3,938 is on the plant and machine, and the 3,005 is on the land. Yes. What dividend? Because that's what they are for the trial balance. 10 plus 8 minus 8, 10. No, no. What year are we doing now? We're doing the year of the, we're doing that year. We're doing that year, 2013. Is there a way to test this 166057? Could we make sure about that number? Could we also use the formula to make sure it's right? Of course. It's really a square. So you just do that formula a year later. Same logic, a year later. 110 as the retained earnings of your parent now, a year later. So basic accounting 1, where does 110 come from? What it was at the opening, plus the profit, minus the dividends. That's the retained earnings of the parent, December 31st. 110, 103, that's the retained earnings of the sub, December 31st, which is what they were. Because when, you have to remember in accounting 1, when you do a trial balance, remember trial balance in accounting 1? In a trial balance, the retained earnings that are there, is it the end or opening? Opening, because all your revenues and cost accounts are still open. They haven't been closed to retained earnings. So you have to make sure that you understand when you read a trial balance, the retained earnings that are there are not the closing, but the opening. And the CMFVA a year later, the 1,400 is easy to understand. It's 1,050 a year ago, 3 plus 350 of this year, 1,004 from your schedule. The 4,413 is the 3,938 minus the 500 something. We're now down to 3,413. The 3,005 is again the same, always the same loss on the land. Every year you have to, some people say, well, I've done it last year, why am I doing it again? Because consolidation is always out of the books. You always have to keep redoing stuff because it's actually never done. 3,005, why is it a plus? Because it was a loss. And the 630 is the 900 net of taxes. And it makes your 166,057. So are we sure about it now? We're sure this way, we're sure this way. Balance sheet. Inventory, you all have 177,540. It's always just the end, because we're now taking a picture at the end of the year, so you all have to worry about, it was the problem with these inventory. When they were at the beginning, we don't care anymore. So the only problem with those inventories, the $900 that shouldn't be there. Investment goes away. Plant and equipment, mine plus yours, plus 3. What's the 3? The UFVA, 5,000 minus a few years of amortization. What's the 4,875? What's the 4,875? On material. You have to be able to name it, because when you're going to speak to other accountants, you have to have words. What is the 487? Yeah, it has a name. What's the name of it? It's the unmaterialized gain on the intercompany transaction. You have to be able to name things, or else you will not be able to speak to anybody. What's the 5,000? The unmaterialized loss. Yes?
For the exam, let's say we created a separate account for land.
Oh, you could. Yeah. Here it says it was all in plant, property, and equipment. It was all in the same.
Same thing for DTA and DTL?
Yes, DTAs and DTLs could be netted and could be separate. Huh? And how do we know? If we go back to our ACCO 320 class, you have learned when is it we can net stuff and sometimes we can't. So I have a receivable from John and a payable to Peter. Can I net them in my balance sheet and report it at the net? Why not?
Not related.
Because?
Not related.
Huh?
Not related.
Not related? Not this, it's not, these are not the real rules.
Does it have to do with current and non-current?
No.
Because one has contract, other one doesn't have.
No.
There's 2 words you have to remember, because there's no contractual right to do it and no intention. Right, intention. These are the words professional. When are we allowed or not allowed to net? There's legal right and intention. Could it be that John could pay Peter? I could call John and say, you pay Peter. Is that possible? Yes, there are agreements in business that I don't want to see the money. You pay my supplier. My clients pay my supplier. Could that be? Yeah, with the B2B business type of business now, we could just avoid cashing in the money and then spending. So then we could, but they would have the right to do it, which I don't think they do. My client or my supplier cannot go and pick in my client's bank account, probably. It's still because of me that they can do it. So you've all learned that accounts receivable and accounts payable are not possibly netted in balance sheet. Or else companies could actually play with their balance sheet very easily if we allowed that, right? It's like in politics. Sometimes they talk about the net debt of the country. What is that, a net debt? It's my liabilities minus my assets. It's like if you had just bought a house of $500,000 and the house is worth $600, what's your net debt? It's positive, my God. It's much more fun to talk about our net debt than to talk about our debt. It's true that I'm really not indebted if I have a house of $600 and a mortgage of $500. Economically, my net value is positive. But it also means that I have to work to pay that $500,000, right? Because I will not use my house to pay my house. So that's why you cannot report the house against the mortgage, you know. House is there, mortgage is there, two different things. It's very easy to put, to manipulate information. Talk about your net debt, you're gonna look very rich. Talk about your debt, whoop, different. So that's why we have rules to compensate. So DTAs and DTLs, coming back to this. Should we, can we net them or not? Legal right and intention. In Canada, how many governments do we have? Two, federal and provincial. So could I have a DTA to federal and a DTL to provincial?
Yes.
Could I net them?
No.
No. In consolidation, I could have a DTA in my parent, which is in Canada, and I have a DTL in my sub, which is in the States. So can I net my DTAs and my DTLs? No. So that's why in the books, sometimes they put them separate. In real life, you could, I didn't say should, but could in certain circumstances net them if we're talking the same government authority, because they will be netted in reality. So put them separate is easier. And your DTAs are mine plus yours plus the 270, which is the DTA on the 900, and 1463, which is the DTA on the 4078. Way back. Payables, mine plus yours. Current tax liability, mine plus yours. Non-current liabilities, your DTL, mine plus yours plus 900. What's the 900? The leftover of the DTL on the FDA on the machine. For your FDA schedule. That's why, you see, doing the schedule is all nice, but you have to bring in the numbers. And the 1500 is the DTL on the loss of the land. 5,000 at 30%. Shareholders' equity, mine plus yours minus yours always. Retained earnings from our calculation above, and we balance. Back to the equipment here, you see it's reported at net. If you have to do the two lines, cost and accumulated depreciation, what do you have to be careful about? No, specifically yes, but we've done it. But if you have the two lines, there's a little thing we have to do about the accumulated depreciation regarding the accumulated depreciation taken by the sub before the acquisition. Remember the problem we did together? This 12,000. Let's do a short example. Say at acquisition date, parent as 100 minus 10, 90. And sub as 50 and 5 as 45 at acquisition date. No FBAs, no nothing. Yeah? You have to do consolidation. Your instinct would be 15, 135, right? This is right. This is that. This is wrong, this is wrong. Why? Last night, the accumulated depreciation was 10. This morning when you get up, how much should it be? 10 again. You can't suddenly have much more amortization accumulated in one night. The only thing that happened between yesterday and today was there was a business combination. So this has to stay at 10. So you just have to move up from there to there, this 5. So this is 10, this is going to be 145. 145 minus 10, 135. You just transfer this 5 to the cost line. You now work with the 45. Because it would look it's a detail, but it's an important detail. Because your accumulated depreciation would be really wrong in your financial statements if you forget to do that transfer. The net amount doesn't matter.